Hey everyone, welcome back to Corporate Dakota, the place where we peel back the curtain on company reports, and today we've got a real estate roller coaster from Sunrise Real Estate Group Incorporated. This is their quarterly report for the period ending the 30th of September 2025, and buckle up because the numbers tell a pretty interesting story, especially when you look at how things have changed. We begin with the balance sheet, a snapshot of what the company owns and owes as of the 30th of September 2025. Total assets stand at about $171 million, a slight decrease from around $174 million at the end of 2024. Now look at current assets, cash and equivalent specifically dropped from about $19.9 million. That is a noticeable dip, and it suggests they might be using cash, or perhaps they are in the process of investing it elsewhere. On the flip side, real estate property under development also saw a decrease from about $63.9 million to $59.3 million. This could mean a few things. They might be selling off developed properties, or projects are moving into a less current asset classification, which is normal for development companies. Let's quickly check liabilities. Current liabilities decreased from about $77.7 million to $69.9 million. This is generally good news for a company reducing its short-term debt and obligations. And for shareholders' equity, things look up. Total shareholders' equity at around $101.7 million is higher than the $96.9 million at the end of last year. That gain is mainly due to an increase in retained earnings and other comprehensive income. Now let's talk about how the company made or lost money. The statement of operations for the 3 months ending the 30th of September 2025 net revenues were just shy of $1 million. This is a massive drop, an 87% decrease from over $7 million in the same period in 2024. This is a big one, folks, a huge percentage drop in revenue in just 1Q. ARTA. For the first 9 months of 2025, revenues were about $12.3 million, down from $13.5 million in the same period last year. That is about a 9% decrease. So while the quarter was rough, the year-to-date picture shows a smaller decline. And for costs of revenues for the 9 months ending the 30th of September 2025, they were about $11.5 million, a slight increase from $11.3 million in 2024. This means costs are rising slightly faster than revenue when you look at the year-to-date figures. The result of these changes is a significant operating loss of over $1.1 million for the 3 months ending September 2025, compared to a smaller operating loss in 2024. For the 9 months, however, they actually had an operating profit of about $749,000 in 2025 versus a loss of $686,000 in 2024. This shows a strong turnaround in operations over the year despite the weak third quarter. But here is where the story gets really interesting: other income and expenses. This is where they made a huge comeback. Other income net for the 9 months of 2025 was over $7.5 million, a massive swing from a loss of over $3.4 million in 2024. This was driven by transactional financial assets, a significant jump in investment gain. Because of that surge in other income, net income for the 9 months of 2025 is over $5.7 million, a big jump from a net loss of over $4 million in the same period last year. This is the story. They are not just a real estate company, they are also playing the financial markets. Looking at the statement of stockholders' equity, we see the impact of these results. The balance of retained earnings has increased significantly, reflecting the profits generated, especially the gain from other income. However, there is a growing deficit in non-controlling interest from about $12.1 million to $14.3 million. This indicates that the company's subsidiaries are experiencing losses which are being attributed to outside stakeholders. This is a point of concern, showing that not all parts of the business are performing as well as the parent company. Now for the cash flow statement, the lifeblood of any company for the 9 months ending the 30th of September 2025, cash flow from operating activities was a net outflow of about $2.9 million. This is better than the net outflow of over $5 million in 2024, but still a negative number. They are spending more cash on operations than they are bringing in. Investing activities show a net outflow of about $1 million in 2025, primarily due to those investments in transactional financial assets, the same areas that generated that big other income gain. Digging a bit deeper into the notes, we find that Sunrise Real Estate Group Incorporated is primarily engaged in property brokerage and real estate development in China. We see a number of subsidiaries and investments like Linyi Shangyang Real Estate Development Company, also known as LICE, where they have a 34% ownership and consider it a subsidiary due to voting agreements. There is also Shanghai Da Wei Trading Company Limited STU, which they have a 19.91% stake. And interestingly, this company is slated for dissolution at the end of 2026, which might explain some of their financial activities. The company uses US GAAP and is dealing with foreign currency translation. Since much of their business is in China, The RMB, the Chinese currency, is not freely convertible, which adds complexity. They recognize revenue from real estate sales when control transfers to the customer, which can be over time, or at a point in time the adoption of ASCII 606 did not materially impact them. This section details their real estate projects like the Linear project and the Huayan project called Tianqi, times they have a significant amount of development property stated at $59.3 million, which is pretty substantial. Property and equipment net is fairly small at just over $332,000 compared to their total assets. This suggests they are not a company with massive physical holdings outside of their development projects. Investment properties are valued at around $25.6 million, again showing a core focus on their developments and investment in these properties. This is where it gets interesting. Investments in unconsolidated affiliates are significant, including Stu again with a 19.91% stake, where they have several $1 million invested. Stu is described as a skincare and cosmetic company with a dissolution plan, which is a vital piece of context for understanding their financial maneuvers. Other investments are valued at around $308,000, which is relatively small compared to other categories. Promissory notes payable are at about $1.4 million, with some bearing zero interest. This is interesting and could point to specific financing arrangements. Amounts due to directors are around $752,000. These are unsecured and interest-free, which is a common practice to facilitate director engagement. Amount due to affiliates like Shanghai Shangji Shasj are substantial at almost $28 million. These are described as intercompany transfers for day-to-day operations. Looking at segment information, the company is structured around property brokerage services, real estate development, and investment transaction. The numbers show that for the quarter ending September 2025, property brokerage services had a significant operating loss, while real estate development showed a profit and investment transaction brought in substantial income. This breakdown clearly shows the real estate development is struggling on its own, but the financial investments are more than making up for it. For the 9 months ending the 30th of September 2025, real estate development revenue was over $12 million, but property brokerage was only about $145,000. Clearly, their core business for that period was development. The revenue breakdown further emphasizes this. For the first 3 quarters of 2025, house sales accounted for 93% of net revenues, while property management was only 7%. This highlights the dominance of development sales in their revenue stream. And the cost of revenues follows suit. House sales are 87% of costs and property management is 13%. It seems the house sales segment, which involves significant development costs, is the primary driver of their financial performance. Talking about cash, for the first 9 months of 2025, they had a net cash used in operating activities of about $2.9 million. This means they are spending more cash on running the business than they are generating from it. They believe they have enough cash for the next 12 months and plan to raise more funds through equity or credit facilities to support their growth plans, which is a standard but important statement for any company. Now, for a critical point, management identified a material weakness in internal controls related to personnel, having limited knowledge and experience in US GAAP. They are addressing this by hiring more qualified staff and providing training. This is a common issue for companies operating internationally, but it does raise flags about the reliability of past financial reporting until it is fully remediated sovereign signatures ZISRA. And finally, we see the signatures of the Chief Executive Officer and Chief Financial Officer dated the 11th of December 2025, confirming the accuracy of this report based on these numbers. Sunrise Real Estate Group Incorporated is in an interesting spot. Their core real estate development business struggled in the 3rd quarter of 2025, with revenues dropping significantly and operating at a loss. However, their investments in financial products and other income sources are booming and more than compensated for the development segment's weakness. They are also actively managing their subsidiaries and addressing internal control weaknesses. The company is clearly navigating a complex business landscape with significant reliance on their financial investments to offset the performance of their primary real estate operations. The future direction hinges on the continued success of these investments and the gradual recovery of their development projects. The key risk here is over. Reliance on those financial gains and the non-controlling interest deficit needs close watching. Alright, that is our breakdown of Sunrise Real Estate Group's latest filing. What do you think about their financial strategy and the impact of those investments? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives like this. Don't forget to join our Discord community for more discussions and exclusive content. Everything is linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.